The year was 1910, a time of great change and innovation in America. A private train sped through the night towards Jekyll Island, Georgia, carrying the weight of a nation's future. Aboard, a clandestine gathering of America's most powerful men was underway. These were titans of finance and industry, not politicians, shaping the destiny of millions. What secret mission brought them together, hidden from the public and the press? This meeting would shape the financial landscape of the world, affecting generations yet unborn. Jekyll Island, a secluded retreat, provided the perfect backdrop for this gathering. Its isolation ensured absolute privacy for the powerful to meet without interruption. The island was a sanctuary, far removed from everyday life. Here, they laid the groundwork for a financial system that would change history. The details of their meeting remained a closely guarded secret for years. No official records were kept, and the participants swore an oath of silence. The American public remained unaware of the momentous decisions being made. What transpired on Jekyll Island would have a profound impact on their lives. The men who gathered were the architects of a new financial order. They envisioned a system that would centralize control of the nation's money supply. Their plan, shrouded in secrecy, would have far-reaching consequences. At the heart of this secret meeting was a small group of men who represented the pinnacle of American financial power. These were the titans of their time, wielding influence that stretched across the nation and beyond. Nelson Aldrich, a powerful senator, led the delegation. Aldrich was known for his deep connections and his ability to navigate the complex corridors of power. Alongside him stood Henry Davison, a senior partner at J.P. Morgan, and Paul Warburg, a representative of the Rothschild banking dynasty. Warburg brought with him a wealth of knowledge from the European banking systems. Frank Vanderlip, president of the National City Bank of New York, and Charles D. Norton, president of the First National Bank of New York, were also key figures. These men believed that the American financial system was in dire need of reform. They argued that the decentralized nature of banking was inherently unstable and prone to panics and crises. Their solution lay in the creation of a central banking system to control the nation's money supply and regulate private banks. The plan they devised, later known as the Federal Reserve System, was a radical departure from traditional American banking. This central bank would be the cornerstone of a new financial order, bringing stability and order to the chaotic world of finance. However, their motives were not entirely altruistic. They saw immense opportunities for their own interests. Control over the nation's money supply meant unparalleled power and influence, shaping the future of the nation. The clandestine meeting on Jekyll Island drafted a blueprint that would forever change the American financial landscape. The Federal Reserve Act was crafted to disguise its true nature and appease the public's distrust of centralized banking. Presented as a decentralized system, the Federal Reserve had 12 regional banks to create an illusion of local control. However, true power resided with the Federal Reserve Board of Governors, appointed by the President. The Federal Reserve was granted the exclusive right to issue currency, controlling the nation's money supply. This shift to a fiat currency system had profound implications, introducing an era where money's value was based on governmental trust. The Federal Reserve's ability to set interest rates allowed it to control economic activity, shaping the financial destiny of the United States. Whispers of conspiracy, the Titanic's tragic end. The sinking of the Titanic in 1912, a tragedy that claimed the lives of over 1,500 people, sent shockwaves across the world. Amidst the grief and horror, whispers began to circulate, linking the disaster to the creation of the Federal Reserve. Several prominent figures who had opposed the creation of the Federal Reserve, including John Jacob Astor IV, Benjamin Guggenheim, and Isidor Straus, were among the passengers who perished in the icy waters of the North Atlantic. These men, outspoken critics of the proposed central bank, had used their wealth and influence to rally opposition to the Federal Reserve Act. Many people piecing together evidence speculate that the sinking of the Titanic was no accident, but a deliberate act of sabotage, orchestrated by those who stood to gain from the establishment of the Federal Reserve. They point to the fact that J.P. Morgan, a key figure in the creation of the Federal Reserve, was originally scheduled to sail on the Titanic but canceled his trip at the last minute. While evidence to support these claims remains largely circumstantial, the theory persists, fueled by the suspicious timing of the disaster and the prominence of its victims. The sinking of the Titanic serves as a stark reminder of the high stakes involved in the battle over control of the world's financial system. The Federal Reserve's grip on America. With the passage of the Federal Reserve Act in 1913, the United States embarked on a new era in its financial history. The Federal Reserve, shrouded in secrecy and wielding immense power, would soon exert its influence over every aspect of the American economy. One of the most significant changes brought about by the Federal Reserve was the expansion of credit and debt. With the ability to create money out of thin air, the Federal Reserve fueled a massive increase in lending and borrowing. This easy credit, while stimulating economic activity in the short term, would have long-term consequences leading to inflation, asset bubbles, and unsustainable levels of debt. The Federal Reserve's control over interest rates gave it unprecedented power to influence the economy. By lowering interest rates, the Federal Reserve could encourage borrowing and spending, stimulating economic growth. Conversely, by raising interest rates, the Federal Reserve could slow down inflation and cool down an overheated economy. However, this power to manipulate interest rates also made the economy vulnerable to the whims of the Federal Reserve. Decisions made by a small group of unelected officials could have a ripple effect throughout the economy, affecting everything from the price of goods and services to the value of homes and investments.